Hey everybody, the Three Musketeers are back at your disposal right here. We're here to do everything we can to help you understand what's going on in all markets across the board. Scott and Mike, how are you guys doing?
Great.
So I'm going to kick the can to you guys, put you guys on the spot. What are we talking about first thing today?
I think we need to talk about the Fed, right? FOMC, obviously, yesterday, not much of a change of tune, which I think most people expected. Had someone on Spaces yesterday in the morning say he thought there was over a 50% chance that the Fed would cut yesterday, and then was immediately offered a Bitcoin bet with odds and refused it. So I think that that 50% conviction wasn't quite what it was meant to be when he put his money where his mouth was, considering the market was pricing, I think, a 99% chance they would remain paused. But I think it's just important to note that not much changed yesterday. Still no real expectation of a cut and no real rhetoric that it would happen. In fact, yesterday, Powell sort of had to talk people off the ledge of a potential hike. Right. And assure people that that wasn't going to be a problem. Those weren't questions he's been getting in the recent past. So that was a bit interesting to watch.
Yeah, I thought yesterday the one thing, and what we're seeing today, and I'll throw up my chart. This is the 10-year yield chart, and you can see it's been in a very tight channel. I mean, amazing, accurate channel. These are totally parallel lines. And so, again, was favoring some downside. And the one thing yesterday, and Mike, you might have some color on this, is that, basically they reduced their runoff on the balance sheet, right? So I think it was at $60 billion, and they went to what? Was it $25 billion?
I don't remember the exacts. I'm kind of
somewhere in that. So like what I got the sense of is that the markets were, worried about like, is he going to talk about a hike? Is he going to be super hawkish? And then he basically came in just kind of, hawkish, but not overly hawkish, and even a little bit of dovishness because of the reduction in the balance sheet runoff. And I think that's what's leading to today's kind of float up into Apple earnings. And obviously we have Apple earnings, and then we have the jobs report tomorrow as well, which will be a catalyst. But to me, yields are pulling back. I mean, that, and the markets want that, and so does Bitcoin. And Bitcoin, I think, is bouncing today. If we go to Bitcoin real quickly, bouncing up a little bit back to 59,000 and change. But speaking of Bitcoin, what do you think, Scott, was the big reason for the sell-off the last few days? Was there anything in particular that happened?
Not in my mind. I think it was just time for a retracement. You know that I'm a big homer for the generally uncorrelated theory of Bitcoin, that it tends to move on its own. And so, when I look at the Bitcoin chart, obviously we did finally break range. 60K support had been tested many, many, many times, but we're still at only a 23% bull market correction. We haven't had one over 24% in this entire bull market. And every past cycle, we get 30 to 40% corrections. And when you have meme coins going absolutely insane, the casino open, the washing machine, thousands of new coins, you're going to get people rinsed. This game is not that easy. The market, whatever, the animal spirits, they do not allow everybody to get rich on jokes.
Yeah.
It just doesn't happen. You are going to get rinsed when that happens. It was the most gratuitous top signals ever.
I got to piggyback on you, Scott, because I hope people appreciate someone like you, and particularly you and Gareth. We all know that you've kind of biased to Bitcoin. You've done well in Bitcoin. When you say things like you've been saying for about a month, I hope they listen, because you get a lot of really young people that understand risk reward and human nature, and sound when they're yelling, that's happened. And I want to show you one key chart that I think is all that's going to matter. Now, the Powell's, Fed's, nothing's going to matter. It's by the end of the day tomorrow, if the S&P 500 is below 5,000, and Bitcoin might be indicating that by dropping below 60,000, that's all going to matter for all risk assets on the planet, meaning we will have confirmation that this is not just a backup in beta, it's more of a deeper correction. And I do like how you showed the 10-year note yield, because this to me is a key chart of, this is just a chart of 2-year note yields and a weekly chart in white. If you go back, last time we were at, just above 5%, we bumped above there. Now they're at 488. To me, that's a good peak. Crude oil looks like it's peaked, but the key thing I like to point out on this chart is I just like to overlay how expensive the stock market is versus the last time we were at the 2-year note yield. And I show the S&P 500 versus GDP, how high it was compared to back in 2006, S&P 500 versus the Bloomberg Commodity Index, how high it is now versus the last time we were at 5%, and the S&P 500 versus the rest of the world stock indices, the MSCI ex-US index. So to me, this is the key thing that's going to matter at the end of the week tomorrow is that S&P 500 above or below 5,000? If it's below 5,000, to me, that's a sign that all the dominoes are going to start tilting downward.
So my question, I just want to ask something really quick, Gareth, because at mid April, we had the S&P actually drop below 5,000, right?
Yeah.
And Bitcoin obviously was not below 5,000 at the time. I guess we have it right here. This is showing the 6% drop from the top. But right here, I guess that's Friday, the 19th of April. It dropped below 5,000 and quickly got back above. So what do you make of the fact that we already had that move below 5,000 and it didn't necessarily, an indicator of death, doom, and despair?
If it were easy, I'd have hair.
Yeah.
So I'll just throw in my 2 cents here. So generally from a psychological standpoint, and that's one of the things that has really helped me in trading, is that what ends up happening is when you get below these key even numbers, buyers step up, especially buyers like buy the dippers that have been conditioned for, let's be honest, since probably 09, that every little pullback is a buying opportunity. And so they bought it, right? Oh my gosh, all of a sudden we get S&P below 5,000. Let's jump in and buy it up, which creates the bounce. The question is, do we make a higher high or do we make a lower high here? And I think if I think Mike's right. And if we come back down and take out the recent low that was below 5,000, now you have a lower high and a lower low. And that again, on a technical standpoint, really starts pushing things to a downward move.
That's why they say the more times support is tested, the weaker it becomes, right?
Yeah.
I know I'm kind of glitching when I use TradingView.
And is that Bitcoin's chart? Because you're seeing the lower low there being put in, and the question then is it something bigger? Yeah.
Yeah, I mean, this was 6 tests basically of that range low, which was 60,775 before Bitcoin finally broke it.
And
right,
and I think it's important
to your point. If all the 5,000 S&P buyers bought at the last 5,000, who's going to buy at the next 5,000?
Exactly. And I think what's important to understand from the technical perspective too is what now happens with Bitcoin is now 60,000 becomes resistance, right? When you break support and you go below, now that becomes resistance. So now it's going to take a little effort to get back above 60. Doesn't mean it can't, but at least that people just have to understand that that's the next level to get back above. Yeah. So, and then what?
Yeah.
Yep.
It's weeklies, the weekly charts. I think you remember end of the week tomorrow, after payroll, after the Fed, and after Bitcoin's already kind of showing it's breaking down and bumping up against resistance. That's why, to me, tomorrow's close is going to be very significant. So
in regards to that, and this is something, Mike, I'd be curious about your take on it, is so we have a jobs report. We have Apple, first of all, after the bell today. And Apple, I was looking at the chart of Apple, and honestly, I don't really have a great read on it. I'll bring it up here. I basically have 2 levels, right? So we're trading below resistance, right? I have this breakout kind of level right here. So if we got above like 174 and held, you might get a little bit of a breakout. But other than that, if it starts selling off, I don't have major support until down here around 158, 160. But again, does Apple, expectations compared to a lot of the other trillion-dollar companies is a lot lower. Apple made its all-time high back in December, while every other trillion-dollar company made it after the new year. And then we have the jobs report tomorrow. And I guess from the jobs report, my question is, does the market want a strong number or a weak number? Like a weak number, maybe that's stagflationary and people start to freak out, but a strong number pushes yields back up. So which one do we want?
I'll give you my take on that. I have a bet with my colleague, Jonathan Levin. He's more of a macro strategist. And that I'm betting, I want to show you too there, that the number's going to be weaker than expected. And the reason I said is because I got a sense from how Powell spoke yesterday. He's seen the number. Typically, they get it a few days before.
Good point.
That my sense was the way he talked about payrolls, I'm like, it might be weaker than expected. I don't know what portion of it, but overall be determined weaker than, look at the last GDP number. It was weaker than expected. And I'm glad you mentioned Apple. I don't watch individual stocks. I mean, I've owned Apple years ago, but I like to point out what the lessons of Jeff Booth. Technology is happening so fast that Huawei is doing to Apple what BYD is doing to Tesla. And this is one key chart I want to show you. I show you a weekly chart. This is S&P E-minis overlaid with crude oil. Crude oil looks like it's peaking. S&P 500 looks like it's peaking. We have a gap down below, and the S&P E-minis down still about another 10%. I've been pointing out every time, but this pattern straight up without correction until now is this. When you look at pattern recognition and you're a trader, that is a big warning to me that you're supposed to just retrace that whole rally.
Yeah.
And just looking for signals to do it. And so far, it's kind of actually, we made a new high in the week. Let's see if we can close and make an outside week down. That would be seriously bad.
So if I'm getting what you're saying here is you're saying it's likely to be a weaker number, and then the market will take that as a negative.
So I don't know what the market's going to take it as, because it might just take out all the tightening and tilt and transfer easing. I think overall it's set up right now that my sense is Powell, the number's going to be weaker than expected. If it's not, I'm going to lose a bet with my colleague. And my sense is the markets are more likely to go down.
For a Bitcoin?
They've already beta. We'll start with beta. That's the key problem. Beta we've not experienced. Bitcoin is, have to remember, Bitcoin is 3 times the volatility of the S&P 500. But if beta goes down, all the dominoes tumble. And that to me is a risk tomorrow. And I'm sensing that beta's already started to correct. It's on the cusp. It's bounced. It's more likely to go down on a weak number.
Gotcha. All right. Yeah, and I think one of the things that we did see was that with GDP coming in weaker and with inflation still staying, north of 3%, the market is starting to get nervous about a weakening economy. And if it starts to weaken too quickly, how does the Fed react? I mean, the Fed at this point can't react that quickly until inflation comes down, and that's a real negative for the markets. Essentially, the markets won't get their drugs that they're craving in any situation where things are weak.
But goes back to my
base. Need to remember though that when he does pivot, that's usually before the market crashes. So I don't know why everybody's so high on the idea of rates.
My base case is the higher price cure is afflicting the stock market. I don't think the Fed will ease until the stock market goes down and tells them to. Partly because the stock market going up is keeping inflation sticky.
Yeah, absolutely. And I just threw up my chart here. I got the earnings calendar here. You got Apple after the bell, Coinbase, Block, DraftKings, et cetera. And then here's the non-farm payrolls. We have 243,000 expected versus the prior 303,000, which remember was a much stronger number than we anticipated last month. So the idea is, does it come in maybe below 200,000 or even below 150? And then how does the market react? Unemployment rate expected to be the same at 3.8% as well. So yeah, it's going to be interesting. I mean, the takeaways here, guys, is I think from what you're saying, Mike, you're saying you think the markets are ultimately headed lower. Scott, do you have a view on this? Like, are you thinking we're headed lower in the equity markets at least?
My view right now is that we head lower for a few months and then they prop it back up before the election because they can afford politically to see markets go down now, but they can't afford markets to be down in October and November. Which is consistent with the slow summers we've seen in previous Bitcoin halving cycles, consistent with the slow summers that we've seen sell in May and go away in stocks, especially in election cycles. So if they're going to allow it, and yes, I said allow it because at this point, I think they're pulling every lever they can to keep things propped up. If they allow it to drop, now would be the time, right? Sooner than later. I have no idea if that will happen. It's just a rational case to me. By the way, I see someone asking, why do markets tend to crash after rates cut? Can you bring up my screen really quick?
Yes, absolutely.
Really quickly, the blue is yield curve inversions. For anybody who hasn't looked at this chart before, you usually get the yield curve correcting, uninverting. Red is the Fed funds rate. That's the pivot, the red circles. And black is what the stock market does. So you get the yield curve uninverting, then a pivot, then the stock market goes down. It's happened every single time that we have a record of, because the Fed doesn't pivot until something's broken. That's why stocks tend to go down after the pivot, because the pivot is a signal that something is wrong. It's not a signal that everything's great. We can throw some more liquidity in. If things are great, they have literally no reason to cut.
And I think just quickly, just to put more color on Scott's point here, is that it's once they cut, the markets begin. You're right, something's broken, and then the markets begin to freak out that they're behind the curve, right? So they're not cutting fast enough. Oh my God, this is going to be horrendous. People's emotion and panic and fear, which is one of the most, in fact, the most pervasive emotion, start to take over, and that's why. So they're cutting because something's wrong, and the market says, oh my God, they're not going to react fast enough. And let's be fair, has the Fed actually ever been ahead of the curve? I don't think so.
Yeah, well, it's just refresh. They started cutting. The first cut was September 2007, and the reason back then was what was happening with the housing market, and we could see it was rolling over. That was that bear market, and then the first cut in 2001 was basically the first day of the year, and we already had the stock market going down, so the stock market let it down. But the key thing is, last time they started cutting when the housing market went down. This time, and I'm showing you how cheap the equity market was back then, just going back to 2006 when we were at 5% in a 2 note. Now how expensive it is versus a 5% 2 note. And that's why I keep pointing out, even last year, Scott heard, that's why every time I see those 5%, it's like, all right, that's where I think the real money is going. The one who runs leverage money is going to that 5% 2 note and giving up on risk assets. Let the leverage guys play with that for a while. And to me, that's the risk. Is now I think the stock market is going to be the major leading indicator, partly because it's so much more ingrained. It's most expensive, and I show in this chart since 1937 or something, and versus GDP. That's where I just can't get that out of my head. And it's better. What better indication for risk assets and risk on and risk off than good old Bitcoin?
So A couple quick questions. Do you guys think that I'll say this and then I just want to follow it up with a couple charts. Do you guys think that the consumer is finally starting to struggle? We know the consumer has over $1.1 trillion in credit card debt. They've been spending like they could spend during COVID when they had a lot of savings. And then ultimately, they're running up this debt. And I just want to point out Starbucks earnings, one of the biggest drops I've ever seen. I don't know if it ever has dropped more than what it did on earnings. And then also, let's not forget, like Etsy today down 16%, right? That's another consumer.
Bring up my screen. Up my screen. I got a great tweet about this if you want the full summary. Starbucks fell 20% after reporting a 6% drop. DoorDash fell 15% after a 20 million loss. Netflix 10% after a weaker outlook. CVS 17% after net income fell by 50%. Etsy 11%. eBay 5%. So this is consumer spending, right?
Yep.
Yeah, I share my chart. Falling gasoline and diesel demand. I mean, this has just never happened in an expanding economy. Diesel demand is falling at the same velocities it did near the velocity during the Great Recession. Gasoline demand is rolling over. Paperboard box demand is rolling over. All that stuff that used to matter, inverted curves, leading indicators that we forgot about for 6 months, are all going to tilt back. And that's why I think the number one catalyst is that stock market. If just S&P 500 dips below 5,000, then everything you pointed out, people are starting to believe. But until it happens, people aren't going to care. The markets won't care. And you got to make it care. And usually that price action has to do it.
Yeah, I know. I think that's the right thing, and that's what I'm seeing too, and that's kind of why I led that into that question, is that there's very clearly a consumer that's starting to struggle. And, with rates going up, we've seen the mortgage rates go back above 7%. I do think those come back in, but they're going to come in because the economy is starting to struggle versus just because markets are anticipating rate cuts. The other thing to mention here, and again, this is just something that we've all talked about. I've highlighted it on past Market Mavericks, but I said money would start to rotate to places like China. And I just want to point this chart. This is a chart I think we even looked at a couple, maybe not last time, but the time before that, which was like a month prior. But we talked about this bullish consolidation, and then look at what the K-Web's done here. This is the CSI China Internet ETF. It's just ripping higher here. And breaking out even more. So I think this is something that should be watched. Is the stock market in the U.S. has been the leader for a long, long time. Does money flow start to head back to other places? I like the EWZ as well. This is another one that I'm watching very closely, and it's starting to move up pretty nicely as well. So are you still in that camp that Mike, you're still thinking that some of these other markets may play catch up a little bit and revert back to the mean, if you will?
I got to comment on that. China is turning Japanese. One of the largest holders of Japanese stocks has been the central bank, Japanese central bank. It really makes complete sense that Chinese are buying their own stocks, the Chinese government, their Chinese central bank. And we all knew that the the HSI index, Hong Kong Shanghai index, at a lowest level since the S&P 500 since the 1970s was due for tradable to bounce. That's happening. But I want to show you a key thing that I think they might be manipulating too, but it's harder to manipulate. In this gray mart, I show Chinese government bond yields, the lowest in our database now, 2.3%. That's where I think our 10-year note's going to go. Just give it a little time. At the same time, we have VIX volatility index. This is a 20-day moving average of volatility index, 20 week, minus the T-bill rate, bottoming from the same level that we've seen in 2007. That's very scary stuff for risk assets. That's why I think, and I'm just waiting for that inflection point. But what you pointed out about China, be very careful. That's probably their own government buying the market, which the Japanese have done, but successfully so for almost 15 years now.
Yeah, I would just say, like, at least for a swing trader, I don't really care. Whoever wants to push it up for me, push it up for me. And I'll take the ride.
It's definitely a good swing trade.
Yeah, absolutely. So I want to turn back to crypto. I know a lot of people are here for crypto. Scott, like, where are we going in terms of Ethereum? Like, is Ethereum, what are your thoughts on that? I see a BlackRock showing here, but
this is what I was showing. Yeah,
there was a lot of talk that Ethereum would be the next big one to run. There was going to be an ETF later this year. Is that now off the table?
Yeah, the ETF was supposed to be approved in the next 10 to 14 days, but there's been very little commentary from the SEC, and that was sort of a bet people were making. But if we're being intellectually honest, Ethereum ETF was never going to have interest anyways. I think that RIAs and platforms and institutions are just getting warmed up to the idea of Bitcoin, and that's where we're talking about where's the next wave going to come into these ETFs. BlackRock says sovereign wealth pensions evaluating Bitcoin ETF allocations. That's where it is, saying that they're actively having these conversations. Those allocations will happen, and that will be a huge wave, because we know that for now, the ETFs, the spot ETFs, have largely been 90-95% driven by retail. And a lot of those people are just going to hold it and sit there because it's in their IRA and they don't think about it. But there's some who are paper-handed, and we saw 500 million in outflows yesterday, right? The biggest day of outflows. So we do know that those people are going to be affected by price, maybe speculating and not liking the fact that they went slightly underwater, right? But speaking of Ethereum, I mean, Ethereum looks kind of fine to me. I didn't even mean to bring up the Ichimoku cloud chart. I was just kind of laughing at it yesterday. But if you are one of those traders, it looks actually like it's found major support. I just think that it continues to lag. Bitcoin dominance, if you look, since basically, let's look, September of 22, has basically done nothing but go up, right? So the notion that we've had these alt seasons of the past where Bitcoin drops or consolidates and everything goes up. Yeah, we've had Solana and memes and some select AI pumps and these things, but the bulk of tokens that people are holding from past cycles are just dead. They haven't really gone up. They've gone up slightly. They're down still 80-90%. That said, hopefully now Bitcoin dominance will actually drop and give altcoins some relief. But when you talk about what's going to happen with Ethereum, we just need to get back to one of those places where people are confident in Bitcoin. It's ranging sideways, and then altcoins can have their chance. I still believe Ethereum will catch a major bid and catch up, but I'm also talking my book there because I've been saying that for a year early.
Well, and I think one thing to just point out in terms of relative strength, and this goes with your dominance on Bitcoin factor, is that Bitcoin, at least of the major coins that were around in the 2021 bull market, Bitcoin, I think, is the only one that has made a new all-time high, right? Like Ethereum didn't, Matic, Cardano, none of these other ones made new all-time highs from their 2021 highs. And again, that just shows relative strength focused on Bitcoin and buyers coming in from other places for Bitcoin, not so much for the altcoins.
Very hard to beat Bitcoin over time if that's your goal in the market. Like you know, you might trade to beat your index fund in the S&P, right? Trading in crypto to beat Bitcoin, it's a very challenging task. But when you do, you know, if ever you get one of these, you guys remember this in 2021, though, that's Bitcoin dominance dropping off a cliff. We've seen that in little amounts. But if you get one of these, you're going to absolutely annihilate Bitcoin and make life-changing wealth. The problem is you're going to give it right back up when Bitcoin rises.
So I got to piggyback on that one and show part of the chart I'm worried about. I've been showing this for too long. It's a monthly chart of the Bitcoin divided by gold ratio. It is showing divergent strength. I overweight with the beta with S&P 500. It looks like it's rolling back down from a lower high. Now, that's not a good technical signal. It's part of the reason I'm still bullish gold. That's that deflationary sense I think might be kicking in. And I love this chart. This is a month-end chart. You have that crocodile jaw. This is gold on top, and Bitcoin, the S&P 500, you know, closing lower. Let's hope that doesn't continue into month end. But to me, you've seen that little tilt higher in the S&P 500. If that rotates down, then all the dominoes tumble. So I just think of the next potential iteration in trade. And this is why I line it all up. Let's see what happens by then tomorrow. If Bitcoin's, hopefully it's not going to do an island top and break down, but that's why tomorrow's a big closing day, and it might signal that this crocodile jaw is going to continue. That's why I'm still bullish gold and still looking for long bonds at some point to catch up.
Interesting. Just turning quickly to oil. One of the big things that caught my attention is that oil broke a head and shoulder pattern, which again, for me as a technician, is a big bearish sign. I'll pop my chart up and show it real quick here. So very clearly we had the shoulder, head, and shoulder, and then this is the breakdown. And mapping out a target, I have it down to $74 just in the near term. And Mike, I know you've been talking about the economy weakening and then oil having a big down move. You know, are you seeing $50 a barrel oil? Are you seeing 70? Like, what are you thinking on that?
So I'll repeat what I said 2 years ago, to quote Jesse Livermore in September 1929. And that is, I think oil is going to get close or maybe even below $50 a barrel. First of all, we're just starting to remove that geopolitical premium. We have found out that it has not cut supply, but it's actually aggravating what pressured oil in the first place, the excess of supply demand out of US and Canada. And I show you this chart breaking down. I like to overlay it with the S&P 500. And oil's been in a decent wedge. It looks like it's going to break below it. If it just follows natural gas, it's just simple lessons of cycles. The high price cure goes to low price cure. Natural gas did it. It got too low. It finally bounced. Crude oil hasn't done it. The problem is we still have the major pressure still pushing it lower. And I look at managed money net positions in petroleum. They just peaked near the high they did last year when crude oil peaked at 95, but they peaked with crude oil about 87. So the hedge funds have started selling. And they drive the market, not OPEC. So to me, this is a matter of time. Absent some kind of surprise supply shock, if the S&P 500 goes down, there's little hope for crude oil, but to go back down to what it almost always does. I'll end with this. The fact is, since the peak in 2008, it's made lower lows and lower highs, and every low has been around 40, or of course, if you include negative 40, which we can just say that's helped spike the rally to 130.
One thing just in terms of commodities that I almost forgot about, but I got to point out here is, have you guys seen the cocoa chart? The collapse that thing's experiencing? Holy cow. So we all knew this was a bubble, right? We all knew this wasn't going to be sustainable, but look at this drop from literally a week and a half ago, 12,000 and change, to now 7,600. I have a target here just in the next few days where it may bounce, but that is a massive drop. And I saw gasoline breaking down, and I think that's what the Fed wants, right? I mean, the only way they're getting inflation to fall is probably by getting gasoline, oil, some of these other commodities to come in so that prices can actually stabilize.
Well, I love the, if you want the number one measures of consumer sentiment, you just need two factors: the stock market and gas prices. Everything else is meh compared to that. So to me, that's just a matter of time. But commodities do what they always do. They have to get cheap after getting too expensive. Cocoa, I enjoyed writing the technical analysis on it starting a few years ago for my colleague, Diana Gomes, and it showed all the classic signs of breakout. But I really feel bad having been in that space and having had customers. I'm sure it ripped the face off a lot of producers who hedge and then have to get stopped out, and then oftentimes really hurts their businesses. And now it's probably going to go back like it did. The high we made around 10,000 was very similar to the one we made in 1977, around 5,000. It's probably just going to go back there. It's a question of time.
My chart doesn't go back that far on this one, at least. But all right. So we have a couple minutes left, Scott. I wanted to kick it over to you and talk about, like, so where are you? Are you still like fully Bitcoin? Are you spreading your money? Obviously, you have TLT. We have some other position. Like, where do you think there's opportunity for investors, or do investors need to just play it safe right now? Oh, I think you're on mute here.
I was just say, it totally depends on your time frame. You know, and to me, that's the key kicker. That's the S&P. But like, if we're looking at Bitcoin, I wouldn't be surprised if this is exactly what we see until the fall, because it's what I thought we would see until the fall. You know, a little bit of this and some of these and some of those. Like I think that I think we're going to go super sideways, boring, low volatility, more correction. I could be totally wrong. I think that'll happen with stocks as well. I said, but I think that if you hold out, I think Bitcoin goes much higher. I think, statistically, the odds that this is the forever top on Bitcoin are very low. So if you have a longer time frame, I think that any dip, 25% or 2% or 40%, is a buying opportunity long term. If you can buy at 59 and it still goes to 50 but ends up at 90, do you care? You shouldn't, right? Yeah. Because you're not trying to time the dead bottom. So I think that this is a decent time to start loading up on dips very carefully, taking nibbles. I mean, I'm a Bitcoin buyer at almost any price, so that's pretty rich coming from me. But I can't bring myself to buy much stock like that. I can't do. So, I guess like money where mouth is, I'd much rather be buying Bitcoin at 59,000 than the S&P at 5,100. But I'm also like I said, I never underestimate at this point the power of the government to prop things up. I just it's very hard for me to get around the valuations and all the charts that Mike shows and just how expensive stocks are relative to everything else. You don't want to buy the most expensive asset versus everything else. I like gold too. I think gold's going to 3,000.
Nice. Awesome, guys. All right, well, let's end it there. I think that was an action-packed, a lot of information. Market Mavericks today, guys. Gentlemen, thank you, guys. Thank you all for watching. You have the socials at the bottom here, so please follow everyone on the panel here. And the big question is, I'm going to put you on the spot, Scott. Are we here next week? Are we doing this next week, or are you on a?
I'll be here next week for sure.
All right.
For sure.
All right. So, folks, we'll see you next Thursday at 3 p.m. Eastern time.
Always
Take care.
Bye.